All right, today we're doing something a little different. We're not just going to explain a topic. We're going to crack a case. And our main piece of evidence, it's this single page of transactions from a company's January ledger. Our mission, if we choose to accept it, is to decode every single entry and figure out the key accounting principles hiding in plain sight. And here it is. This is our case file. Every single number, every account name on this page, it tells a story. And hidden inside these journal entries are five crucial accounting principles that can honestly trip up even the pros. So our job is to pull them apart, one by one, and really get to the bottom of the logic behind these numbers. Okay, let's dive right in. Our first mystery revolves around a really simple but absolutely critical question in business. When stuff gets shipped, who's on the hook for the transportation cost? Believe me, the answer changes everything. So how does accounting deal with this? Well, it really boils down to two main scenarios. First, you've got delivery at buyer's warehouse. Just think of this as door-to-door service, right? The seller handles everything. And then the second one is delivery at seller's warehouse. This is more like you're picking it up right from their factory gate. The second it leaves their property, it's all on you. Okay, so let's put this into practice. Look at this, January 2nd. The company buys raw materials for $21,000. The terms? Delivery at the buyer's warehouse. And the seller, they paid $1,500 to ship it. So the big question is, what value do we actually record in our books? The answer is simple, $21,000. That's it. In our journal, we just show our raw materials going up by $21,000 and our bank account going down by the same amount. We completely ignore that $1,500 transport fee. Why? Because the terms were buyer's warehouse. That means the seller was responsible for that cost, so as far as we're concerned, those raw materials cost us exactly $21,000. But now, let's flip the script. Check out the very next day, January 3rd, a different purchase. This time, it's $10,000 in spare parts. And this is the key, notice the terms have changed. Now it's delivery at the seller's warehouse, and we paid the $800 for transport. So how does that change the journal entry? And this shows the other side of the coin perfectly. The total cost to get these spare parts wasn't just the $10,000 price tag, right? It also includes that $800 we had to shell out to get them to our door. So the asset's value on our books is actually $10,800. In accounting speak, we say that transport cost is capitalized. It literally becomes part of the asset's official cost. This all leads us to what I like to call the golden rule of shipping. It's so simple. Cost follows responsibility. If those goods are your responsibility while they're on that truck or that ship, then the cost of that journey becomes part of your asset's total value. Just remember that, and you'll nail this every single time. All right, on to case file number 2. So on January 13th, the company writes one single check to cover a bunch of utility bills. Simple enough, right? But wait. In our records, one of the expenses is missing. It's our job to figure out what it is. This is some classic accounting detective work, and it's actually pretty straightforward. We know the total amount that left the bank account was $19,000. We also know what we paid for power, lighting, and gas. So we just add those up. That gives us $13,500. Then it's just simple subtraction. The total payment of $19,000 minus what we know, $13,500, and that leaves us with the missing piece of the puzzle, $5,500 for the water bill. Case closed. Okay, our next case is all about something super common in business, paying for stuff before you actually get it. Now, this isn't just a one and done kind of thing. It's really a two-part story that unfolds over a couple of days, January 15th and 16th. So on day 1, January 15th, we send out $20,000 to a supplier. But here's the crucial part. We haven't received a single thing yet. So in the world of accounting, we can't just call this inventory. Instead, we record it as a different kind of asset, an advance payment. Think of it as representing our right to receive goods down the road. Then on day 2, boom, the $100,000 worth of goods show up. Now we can apply that $20,000 credit we already paid and just pay off the remaining $80,000. So you might be asking, why all the fuss? Why the 2 steps? Well, it all comes down to a really core principle in accounting. You simply cannot record an asset, like inventory, until it is physically under your control. That first $20,000 payment, it's not inventory. It's just a placeholder, an IOU, an asset that basically says, hey, this supplier owes us some goods. It's only when the items actually arrive that we can finally convert that placeholder and the new payment into real inventory on our books. Next up, we've got a transaction that happens entirely within the company's own four walls. So we're not buying anything, we're not selling anything, we're just moving assets from one part of the business to another. And yeah, we still have to record it. So on January 28th, some materials are taken from the storeroom and moved over to the factory floor. No money changes hands here, but this is still a super critical transaction. Why? Because it reflects a transformation. Those materials stop being just an asset sitting in a warehouse, inventory, and they become part of the cost of goods sold. We're basically tracking the exact moment our resources are put to work to actually create value. It's an absolutely essential piece of bookkeeping if you want to understand a company's true production costs. And now for our final and maybe most complex investigation, the end-of-month cleanup. Oh yeah, this is where we deal with all the messy stuff. Damaged goods, employee mistakes, simple typos. This is where a good accountant really earns their paycheck. Let's kick this off with a little puzzle. So we lent some special packaging to a customer, think big crates or containers. When we sent them out the door, they were valued on our books at $2,000. Okay, so when we finally got that packaging back at the end of the month, we gave it a good look over. And because of just normal wear and tear, it's now only worth $1,800. So $200 of value has just, poof, vanished. How in the world do we account for that? A really simple analogy makes this crystal clear. Imagine you lend a friend a book that's worth $20. It comes back a little beat up, maybe the corner's bent, and now it's only worth $18. You got your book back, sure, but you also took a $2 loss. That's exactly what's happening here. That $200 difference, we just recorded as an expense. It's a normal cost of doing business. We got our asset back. It's just a little less valuable now. And finally, on the very last day of the month, we discover two different shortages in our inventory count. Now, the first one is a 290 shortage, and it was caused by an employee's mistake. Because a specific person is responsible here, it's not treated as a company loss. Instead, it becomes a receivable. That employee now literally owes the company 290. But the second shortage, for 270, was just caused by a simple typo. An item worth 630 was accidentally punched in as 360. For that one, we don't blame anyone. We just make a simple correcting entry for the 270 difference to fix the books. So you see, two shortages, two totally different solutions. And it all comes down to the why. Which brings us to our final thought for today. After decoding all these different transactions, everything from shipping costs to clerical errors, it becomes pretty clear that the numbers themselves are really only half the story. The single most important question an accountant can ask isn't how much, it's why. Why did this happen? Who is responsible? What are the terms? Answering that question, that's the real key to getting the accounting right every single time.